Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending June 7th, 2019. Let's jump right in. So here's the S&P 500. I'm going to pick up where I left off last week because I like to provide continuity and context. So we were very oversold last week. The S&P had been down all of May, but not down that sharply, not in big panic selling. So my opinion last week was that we were going to test down here somewhere to about 2700 to 2740 in this range of the March 8 pivot low. And the S&P came down to what? Let's see. Oh, it came down to 2728 on Monday morning. Much uglier in NASDAQ. The week was really ugly as far as like data and occurrences, events. For instance, the NASDAQ sold off really bad on Monday, down 2%, because the government is opening antitrust investigations into Amazon, into Google. Facebook was thrown in there as well. You had really bad jobs data. The jobs growth was less than half of what was expected. Global PMIs were down. Korean exports were down. German manufacturing collapsed. And you also had trade war, kind of tariffs ramping up on Mexico and India. So the market rallied really strong, the best week since November. So we see it right here from Tuesday. Pretty spectacular. It's one of those environments where if you feel like bad news is good news, you're right. And I'll tell you why in a second. But first, we had this Monday down day. Tuesday was just spectacular. Remember last week I was saying this market was really oversold. That's why I wouldn't touch any new short positions as oversold as it was. It was due for some kind of correction, and I don't want to be entering the market short when it's that oversold. But that doesn't account for all of this. And let me show you in a different context on a weekly chart. This is this past week. Let me zoom in a little bit. Entire month of May down, but this past week, that's a bullish engulfing candle that retraced 1, 2, 3 weeks of downside price action in 1 week. It was the best week since the end of November, which is right here. The key developments were, number one, market oversold. Number two, coming into some potential support at this pivot. And number three, this day, Tuesday, there was just an amazing short squeeze. You got to figure the shorts are piled in there after a month of going down. But that wasn't it. CTAs came in and they flipped on Tuesday from 100% short to 97% long in 1 day. Amazing, amazing inflows that day. And the market on this day went from being the most oversold it had been since the end of this sell-off. It went to almost overbought in the first few hours of Tuesday alone. The other big thing that happened, and this is why bad news is good news, the market has been pricing in slower growth and that the Fed needs to cut rates. You can see the 10-year yield here just plunging, especially in May. This is the bond market saying the Fed is behind the curve. So here's what happened. Monday over here, the St. Louis Fed President James Bullard came out and he started talking about cutting rates. And then Tuesday over here, Powell came out. Now, Powell has been saying neutral. We're neutral, which means our next rate move could be up, it could be down. We don't know. We're just watching. We're neutral. He got rid of all that language and started saying, well, it could be time to cut rates. So he's coming around to the market's view. And the more bad news you have that's slowing growth, the more likely the Fed is going to be forced to act and cut rates. So that is part of what all the strength was this week. The last time we saw moves like this was back here in early January when Powell did the same thing and went from hiking rates right here to 3 weeks later saying, we're done, we're on hold, we're patient. Okay, so he made a dovish pivot. That's part of what's going on here and part of why all the bad news is good news. What about that oversold condition? Here's the market from December sell-off. You can see it here. That's the S&P 500. This white line is the NYSE new high, new low ratio. So as of Friday of the prior week and Monday of this week, the market was the most oversold it has been since its vicious sell-off in December. What is really spectacular about this, see it goes from 0 to 100 like an oscillator, is that it went from nearly 0 up to overbought in the first few hours of Tuesday alone. That's how big that CTA and short covering inflow was. The takeaway here is I'm no longer worried about shorting the market because it's oversold. It's getting up into the overbought territory, but that's not a good reason by itself. In terms of price action, the market went from could not do anything right over here to this week hasn't done anything wrong. The S&P basically rallied up to its 50-day moving average. That doesn't mean that there's a resistance or that anything's falling apart. As far as price action alone, it looks fine. It looks great. The Dow did the same thing, came up to the 50-day moving average. Now there does appear to be some resistance right here at 26,000. It's really close, I think a point or two from the 50-day moving average, and it's a psychological whole number that human minds gravitate towards. Now small caps, they don't look as good. So here's Monday, and here's their bounce through the rest of the week. The bottom line here is that they actually started leading the market on Monday and Tuesday higher. So if you looked at small caps relative strength versus the S&P 500 or IWM versus SPY, what you'll see is that the relative strength improved. Small caps were starting to lead higher. This is relative strength. It's not Wilder's relative strength. It's basically comparison between the IWM and the SPY or the S&P 500. So I'm going to zoom in closer on maybe a 5-minute chart at this area Monday, Tuesday, starting the week. Okay, so now we're on a 5-minute chart. This is Friday the 31st. This is the start of the week here, Monday. It doesn't look like small caps are doing a lot except testing this support and holding. This is where you find value in comparing one thing to another. In this case, IWM against SPY. I'm going to put up a trend line here real quick. And what you'll see is that on Monday, Tuesday, it started showing better relative strength here. Even though price wasn't moving higher here, relative strength against the S&P was. Small caps tend to lead the broader market, both up and down. Now this completely changed on Wednesday. You can see they broke that trend of relative strength, and Thursday and Friday just kept going lower. The other area that led the market higher, this is the May downtrend, and this is coming into the start of the week, was materials. Now this is a really lightly weighted sector. It doesn't have a whole lot of influence on the S&P, but it was the first sector to break out of this downtrend on Monday here, and this went on to put in 9% gain on the week. It was its best week since the financial crisis. If you're looking for things that are wrong in price action, like I said, you can't say anything is wrong with this, right? It's a straight line up. We do have some kind of resistance levels for some of the sectors. But let me pull up the financial sector. So here again is that downtrend. It is feeling a little bit of resistance here at 27.25. This is the energy sector. Here's the decline at the end of May. So it has moved up this week, but this is one of the sectors, one of the only sectors that's trading in this little bear flag as the market has rallied. Now it's a little bit above, so it's kind of touch and go. We got to watch it, but bear flag there and a bear flag in crude oil. So crude oil has rallied this week, but it's doing it in a bear flag, which means it's much lower activity. So if we looked at something like the tech sector, you can see it blasted off through this May downtrend, much different tone, character, and feel to the tech sector, even though it was only up 1.5% more than the energy sector. But you could just really see there's nothing wrong. Very, very strong trend here. Go back to XLE, energy sector, you have a bear flag. So financials are coming into some resistance. Not really great tone here in energy. XLC, the communication sector, is another one. Of course, it did rally. Okay, but it's still stuck in this May downtrend and right here at some resistance around 47.50. So you got 2, 3, 4 sectors that are into potential resistance but haven't done anything wrong in price except for energy. As has been the case really since April, it's not just the price trend, it's how other assets are acting. So there was a few things that stuck out, not in price action of the S&P or the most of the sectors, but in treasuries for one, in safe havens like the Japanese yen for 2, and volatility again. Here is TLT. Remember, we got out of this trade last week, went up a little bit higher, started to consolidate in a bullish flag. Now it broke out a little bit earlier than I would have liked it to, and I'm not sure this is going to hold. I think it probably won't hold. But this was the jobs report. Really bad jobs report, very disappointing. So treasury yields plunged. They move opposite of treasury prices because they are reflecting slower growth, and the fact that the report was so bad increased chances or probabilities, bad news is good news, that Powell will cut rates because of that. So that is why Treasuries are out of this flag. I'd rather have seen them stay in it. Maybe they'll come back down and we'll get something constructive we can work with and get into another leg here. Too early to say. Gold was a position I carried long into this week. Got in on this day here and have been riding it. So it hit my target range for the first leg up, which was around the 126 area. Got out of it here on Wednesday. So I was looking for a consolidation here too. Let's go to a intraday chart. Here's Wednesday when I got out. There was a little bull flag, and as I said earlier in the week, I would have preferred it stayed in this bull flag, built up some energy for the next advance. When it popped up higher, so I held it this day, it popped up higher. Wednesday, I could see it was just time to take a break here and got out of it. So it started making this little consolidation. This is kind of an ascending triangle. You have a flat horizontal area of resistance here and a slightly upward sloping lower trend line. So I was hoping it would stay in here, bounce around here in a couple days, build up some energy and break out again. And for the same reason, it broke out a little bit on Friday. I wish it didn't. That was for the same reason that the jobs report was so bad, the dollar plunged and dollar-denominated assets like gold moved higher. So truthfully, I would like to see it come down and pull back into this range. Now, if you're still long gold, check this out. It's making higher highs and higher lows all the way. Even here this week, you have higher high, higher low, higher highs, higher low. So you can always put a stop maybe down here at the bottom of this correction by say 125 or a little bit below, whatever you're comfortable with. You could put a stop right here, about 126.40, something like that. Or you could just put a stop at this lower low here. So either a stop here, here, or here if you want to keep it nice and tight. I'm hoping that we'll be able to get back into this after a pause, a rest, consolidation. So the point is, defensive assets, safe havens. Gold still acted great. As a matter of fact, on Friday, you had the S&P up, you had Treasuries up, you had gold up, and volatility was up. Strange. Treasuries were acting much stronger than they should have on a week the S&P did this. Gold was acting stronger than it should have been. Today, volatility actually closed up more than the S&P. Here we have the S&P in the candlesticks, and we have the 10-year yield here. So notice they kind of track with each other. This was the start of safe haven flows. This was really discounting growth and saying, hey, Fed, you need to catch up to the market's expectations, and the market says rates need to be lower. If you're not going to do it, we're going to do it. So what you would expect to see on a big, strong week like this is Treasury yields to either move in sync with the S&P or even lead them. So if they're leading, that means people are moving out of Treasuries and they're entering risk assets like the S&P 500. That didn't happen at all this week. So you can actually see made lower highs, and we have a new low, not only for the year, but going back to September 2017. So my point is here, you got a big divergence. Treasuries are not playing along. Another thing that stood out all week was USD JPY, the dollar versus the Japanese yen. So this is a daily chart. I'm just going to throw up the S&P real quick for comparison. You can kind of see what I'm talking about. S&P in blue. So you see they tend to move together. So USD JPY moves higher, the market moves higher. They move lower, the market moves lower, so on and so forth. So what is basically happening here is, number one, USD JPY, US dollar against Japanese yen, is a carry trade that traders and funds will use to basically make money in that and then invest that in stocks. And when they get scared, they rotate out and they go to the safety of the yen. USD JPY falls. So this is 2019. You could see not making a higher high here, but what I really want to focus on is this week right here. So here are the trend lines, a little messy. Just think about it this way. Going up, risk on. It's supported for the market. Going down, risk off. Okay, people are getting out of the market, getting into safety of the Japanese yen. And here is January through March, April over here. Here's the May sell-off. So you see it's going down, risk off with the market selling off. This was last week, and this is this week. Now I'm going to zoom in closer and show you some intraday charts. And what I do for members is I give exact ranges of where it's either supportive of the market, like here, or it's going risk off, like here and here. So the prior week, what I said was you had these two levels here, 109, right, and 109.75. This was the week before last week. So if it goes in between this range, you basically expect the market to consolidate sideways, chop around. If it goes above, it's supportive for stocks, it's risk on. If it goes below the range, it's risk off. So this is how we entered the week, selling off sharply. Remember, those fangs were under pressure. This is how it traded the rest of the week. I can throw up the S&P, but because they trade different hours, it's going to look a little funny. So here is this week, S&P soaring. This stayed in this range, just chopping around sideways. Did not even get into the consolidation range over 109, and certainly did not get up here at 109.75. It probably should have been above 110.50, maybe even 111. So absolutely no tolerance for risk in terms of the people who are holding the yen as a safe haven, meaning they do not want to rotate out of these safe havens and chase stocks. They want to sit right here. They're fine holding their Japanese yen, their safety. And that was the case in Treasuries. It was the case over here as well. So the bigger takeaway really is that, yes, we got a really strong rally off an oversold condition. There's nothing wrong with the move, but other areas of the market that you would expect people to say, okay, I'm going to lighten up on the bonds, I'm going to lighten up on the yen, and I'm going to buy some stocks. That didn't happen. One more thing, and we'll wrap this up. That is, what the hell is going on with volatility? So for members, you know that as of Sunday night, when stocks futures were down, and Monday when the NASDAQ dumped 2%, so very risk off, volatility on 3C charts, the VIX futures, were under selling pressure, which means, in my opinion, somebody is trying to knock volatility lower to support the market, help it find that low and bounce or rally. It's kind of interesting that it happened 2 days before Powell spoke, because we always see this before Fed events. Somebody goes and crushes volatility. I suspect it's the New York Fed's open market desk, but the net effect is that the market behaves well when Powell or the Fed speak. They can't be blamed for the market selling off when they raise rates or do whatever they do or have whatever opinion they have. Volatility selling pressure, and I'll show you that in a minute. That was Sunday night and especially Monday. As soon as we got to Tuesday and the market started to rally, all of a sudden there was buying pressure. Now VIX itself was still down. That buying pressure really built up and it started moving in price on Friday. So the S&P was up 1% Friday. What is volatility doing up 2.3%? So here's a depiction of it. This is VIX futures and this is 3C, so it's basically the underlying tone character if there's buying or selling pressure. Here is Sunday night right here where volatility opened, gapped up. Look at the selling pressure from Sunday night, really as soon as it opened up, really kind of flowing over from Friday. And that kind of stayed on. This is a little bit bigger picture chart, not as sensitive as the ones I usually use. But as we get into Thursday, Friday, look at this positive divergence. And it just so happens that on Friday, volatility showed unusual relative strength, up more than 2 times the S&P. Top window, S&P 500, SPX, and this bottom window is the 10-day correlation of volatility to the S&P 500. So in a normal environment, volatility moves opposite of the S&P, so it would usually be down here around -1. So really come into the week with a normal correlation, volatility acting as it should, which means not well, and making higher lows through Wednesday, Thursday, and on Friday we get this big correlation spike. That's what I was just saying, with the S&P up 1% and VIX up 2.3 or 2.4%. So something unusual going on in volatility again. It's nowhere near the size of what we saw in April, but it started out this exact same way. So something is up here, something's going on. Maybe it's just, people are nervous about the Mexico tariffs that could come into effect Monday. Maybe it's something else. We don't quite know yet, but we do know that treasuries are not playing along with the market, that safe havens like the yen are not being sold, and somebody is buying volatility quietly under the radar, and that first manifested in underlying trade. Now it's manifesting in price. Okay, so wrapping this up, market is still strong. We have some potential resistance in the Dow, the S&P up here at the 50-day, Dow 26,000. There is some resistance in the financial sector. Possibly there could be some resistance in communications. But look, from price perspective alone, there's no reason to be selling short right here unless you really feel strongly about this resistance. Now that could happen quickly. If I was long, I would be very concerned about treasuries not coming down very much, about gold being up, and about what's going on in volatility. So I would be cautious and have some pretty tight stops. And then when we see some price action develop, as we're seeing like in energy right now with that bear flag, that's kind of one dent in the hood of the car. Let me show you one last thing real quick. So just the tone on the week. So here's the SPY. Here is Monday morning, Tuesday, Wednesday, Thursday, Friday. So really great confirmation, no problems on the 3C chart. A little bit of falling off here towards the end of the day on Friday, up around that 50-day moving average. Now QQQ looked a little worse. So here's QQQ, again confirmed through most of the week, no problems. And then Friday, what was that? Okay, and then Friday, we do see a little bit of falling off here. We're going to watch this into next week. Of course, watch what's going on with TLT. I love it. I just wanted to consolidate a little bit more. And gold, we just got out of this Wednesday over here. I do want to get back in again. What was our gain on that?
It was 178%.
Okay, so it was a nice trade. But I do want to see it consolidate a little bit more. I don't watch these things like she does. She takes care of all the execution. That was the lovely and talented Andrea, by the way, coming in and disturbing my video. So again, here's gold on that 15-minute chart. Did kind of break out of this consolidation. I'd rather it didn't, but gold doesn't have to do what I want. I just have to keep watching it and react to what it does. I would like to see it come down back here in this 125.50 area, bounce around here for 1, 2, 3 more days, whatever it be, as soon as we see that underlying flow pick up. But right now, they actually still look pretty good, TLT and gold on underlying charts. I'm a little bit surprised, but that's just been the tone of the week. The defensive things have rallied with the broader market. So let's wrap it up there and have a fantastic weekend. Members, I'll see you on Monday. I am doing that research for, I'll just mention this briefly. I'm not going to go into any detail. But with the Fed getting ready to cut interest rates, there are certain things that are very predictable, and there are certain trades that you can ride and let the Fed do all the work. So we're kind of mapping out, I'm in the process of mapping out where we want to be and what the timing of that rate cut might look like. So you never know with them. He's already kind of starting to move in that direction. But the point is, there are some fantastic sectors that you can ride on that actual rate cut that they make, and there are some other trades in other assets, including treasuries, kind of longer term, but you just let the Fed do the work because they're so predictable in what they're going to do. They're going to send rates back down to zero probably in the next 1 year to 2 years. I'm thinking maybe 1 year. So it's kind of a longer term trade, but this is the kind of trade that people, at least investors, hedge funds and stuff like that, they make their names on, and they let the Fed do all the work. So we're going to be looking at that too. I'm running over. Have a great weekend, everybody.